Well, thank you, everybody, to come to the manager selection panel. This is always a fun one because we have such wide-ranging topics. And we just don't look at manager selection. We take a look at the environment, what's going on in the world, and how you can invest both on a family office as well as an individual basis, because a lot of people want to, make some individual investments too. So, there's a lot of things going on in the world here. Yesterday, John Paulson said if the Democrats win, he's going to expect the market crash. He's going to be in cash and gold. Now, I don't know what happens if Trump wins, although a lot of people in 2016, both the television commentators as well as the actors and actresses said they leave the United States. To my knowledge, nobody did. So, we'll see what happens. But in the overall environment, we have what you may call some forever wars in Ukraine, the Middle East, certainly in the sub-Saharan Africa is less known. And then there's Taiwan and North Korea heating up again. And then, we've got, people like Tyson, the fire thing, talking about overvalued markets. I think I'm going to take this call. Hold on. I think that may be our guy here. One second. Go ahead. Hello?
Hello, is this Gary?
Yeah.
Hey, it's Greg Carpenter. How are you?
Yeah, just you got to connect.
Greg is on.
Yeah. Okay,
on,
Greg, you got to connect with. You got to connect
I'm
here.
gonna swap. I think he was on.
Okay, he's got to connect with you. Okay.
1 second.
Okay, I just had a
He's
couple
in.
questions.
Okay. Well, we're right in the middle of
Tell
the
him he
panel.
has to
We
hit
just started the panel now.
He has to hit the hashtag button.
Okay.
Oh, if you could call me back later, that'd be great.
Okay. Great. Okay. So what happens is there's a lot of those things going on. I think that while we wait for our other guest, or is he on here? Are you live?
I have Andy's
Okay.
there.
Okay, you got Andy.
Was Greg going to be speaking on this panel or no?
No,
No,
he's
Greg
not.
is
He's
speaking
talking
tomorrow.
about tomorrow.
Yeah, okay.
He's an M&A guy who's
Yes, you're
trying
right.
to figure out what to say on an M&A thing.
All right.
So I think the best thing to do is have a brief introduction both from Maureen and Andy. Since Maureen came here, I think I'm going to let you be the first one here. A couple minutes about your background and also what you're doing right now.
Sure. So my background is I've been in financial services for about a good 20 plus years. I spent about a decade working for Goldman here and then in Europe. And then I moved over to private equity, and I have done kind of the entire spectrum from buyouts to growth to venture, and I've been on the secondary side as well as on the direct investing side. So I have a lot of experience in secondaries, having done it on the LP stake side, the GP restructuring side, and also buying individual positions in late stage private growth companies. So I can speak quite well on the secondaries market. And currently I work for a firm that is providing liquidity now for basically high net worth, ultra high net worth, and small to mid-sized institutions, and also working directly with general partners who are looking for liquidity as well as for additional capital.
Okay, that was a good one. How about you, Andy? I haven't had the pleasure of meeting you before.
No, this is my 40th year as a professional investor. I started out trading commodities, but quickly I spent the first 20 years inside Swiss family offices, running a hedge fund and several venture funds. At one point we lifted out, but then I went 180 degrees. I built and ran State Street's global fund of hedge funds. So I've hired well over 100 hedge fund managers after having been invested in due diligence and funded companies. By the way, I was invested with John Paulson for over a decade. He's given all his money back, and it's just his money now, so he can say whatever he wants. Going forward, the last 7 years, I went back to the family office world. We build co-investment vehicles with managers. So in terms of manager selection, they're more like partnerships, or they could be projects, and we cut across asset classes in things that we do note. So if you want to talk about hedge funds, venture capital, real estate, we're always dealing with a partner on that. Happy to deal with this in almost any level down to the due diligence level, in fact, which I also reported to me. So I was the CIO of the Global Fund of Pensions.
Okay, so my bio is on LinkedIn quite extensively. I don't know, I got 165 searches last week. I'm not sure if it's because I'm writing a blog for the USC Trojan football team, which is co-authored, it goes out to several hundred Hall of Fame coaches and players in the NFL as well as college people. Or is it Harvard Business School class notes that I'm writing that has made me famous because, you know, at this age, nobody else wants to do it. Or maybe it's just because I'm a panelist at IvyFON that's brought me such fame and notoriety. Yes, notoriety. So that's my story, and I'm going to stick to it. So, we just had a presidential debate a couple weeks ago. Certainly a sharply different view of the environment. Harris said, we're at peace all over the world. No troops are in any, active war zones. Donald Trump's talking about potential for World War III. So there's a real difference in terms of how you perceive what we might say forever wars in the Ukraine, which is now coming up to 3 years, the Middle East coming up to 2 years, and other places that, may be important in our future. So with that, as well as, I guess the first question I'd ask is, do your managers or do you personally worry about what is going on in the world and what could potentially shock you in terms of, well, there's always the October surprise, like the Cuban crisis that happened. And of course, Hunter's laptop, although that's not as big as the Cuban crisis. So maybe you can talk about, are people worried about that? And, what do you think they're going to do to protect it? Once again, I'll start with Maureen first.
Thank you, Gary. I think right now, we're in a period of, I think, potentially extreme volatility. And I think that, there's been a lot of hubris around the coming rate cut. And although they've done the 50 basis points, I don't necessarily think this necessarily bodes well for stocks, in the longer term. And I would also say that I don't anticipate that rates will go down all that much. And so we are definitely in a very different environment than we were in the last 10 to 15 years. And there are many factors suggesting that, which to me means you need to shift your whole way of thinking about how you're going to allocate your portfolio. The one thing that I do think has a lot of weight now is experience. People talk about it, but I would say if you can look at folks who've been investing for 15, 20, 25 years, who've gone through a number of different cycles, who actually remember when interest rates were actually higher, or what happened after the global financial crisis, or what happened in the dot-com boom, that actually matters. And I think that, when I go out there and I talk to folks who've only been, say working in the last 10 or 12 years and don't even remember the global financial crisis, I think that it's a very different perspective. And so I think that is, I guess one of the things is to understand, when I'm looking at managers, what kind of experience they have. And it also depends on what they're actually looking or focusing on. Because obviously, if you're looking at someone with like a buyout background, it may be very different than if you're looking at somebody with like growth or venture.
Okay, so that's a good start. Andrew, any comments on follow up on the environment?
Just a slightly different perspective and taking a little longer one than today's news of a Fed rate cut. Is I'm a big believer in cycles. There are always cycles. I used to always say there's a once in 100-year event. Every 7 years, we just get 20th century. And so that even applies to asset classes and to strategies. There's a cycle in venture capital. Maureen just alluded to that we had this 10 years of every deal being done and every fund being funded. But zero interest rates aren't normal. 2% mortgages aren't normal. As Maureen pointed out, and I think I'm even older than all of them, is that we are closer to normal than people think. I keep hearing, when are rates going to come down? Well, the Fed funds rate is the overnight lending rate between banks. If you look at the 10-year bond, is at 3.6 now, down from 4.6 and down from over 5. That's driving things like mortgages. It's driving things like high yield bonds. It's driving things like corporate finance. So if you look at the type of rates that affect cycles, that affect the world that we invest in, we're much closer to normal than reading the news of the day. And so the Fed is really just normalizing. It's the Fed funds rate over 5% is arguably too high for the inflation rate. But as I said, there's too much focus on that. And so when we go back to managers, and I think Maureen alluded to this, look at the cycle that the manager is in relative to their asset class. If you had a venture fund that said, oh, we had all these exits and we had all this great stuff, you were doing that in a 10-year period where everything was perfect. By the opposite token, if you look at a hedge fund and they didn't make any money for a decade, well, rates were zero, volatility was zero, bankruptcies were zero, really wasn't much for hedge funds to do other than own beta or leverage. So when we go through these transition cycles, you have to look at the managers, not just from the opportunity standpoint, which you should, but also look at what managers, not the portfolios, what managers may be in trouble. Because when you get to the end of a rental cycle, as we have, which venture capital managers have portfolios, legacy portfolios that are on fire? So that's something you want to be very cognizant of. But at the same time, it's a buyer's market in venture capital. So if you're going to invest in venture capital, you have to find the manager who doesn't have their hair on fire, but can take advantage of the situation that exists today. That was the same after the crisis in 08. Our portfolio, we didn't happen to lose any money and we had a lot of cash in 09. Our biggest problem was assets were cheap, strategies were great, finding managers that weren't in trouble, that we had full due diligence and make sure the manager we invested in, not the asset, not the portfolio, was going to be healthy. So that's my sort of combination of cycles, rates, and how one looks at manager selection.
What's interesting too, is I was taking a look at before this panel, fundraising in the last like 12 months, I think across all asset classes, it's down about 45%. I was looking at Fisch book. If you look at like real estate, credit, everything, but if you kind of peel it back, I think real estate's having the hardest time. It's down like 60%. But the good news is that the overall trend is that it's not down as much as it was like say 18 months ago. So it's kind of slowly getting back up there. But the area or the asset class, sub-asset class, it's not down as much was secondaries, which I actually thought it would be actually higher because there has been a lot of money that's been raised for secondaries. One thing I would say on secondaries, and this goes to his point, was the difficulty in finding good managers to really take advantage of some of the opportunities. Like there's been a lot of noise and discussion about doing venture secondaries. And to be honest, like most of the people who kind of know how to do venture secondaries are here actually in the Bay Area, and it's a very small group of people. However, in the last, I would say 12 to 18 months, there's been this fervor of people trying to get into the venture secondary world and take advantage of it, not just only on the individual companies, but buying LP stakes. And that's a complicated market, and it's definitely nuanced relative to buying growth or buying buyout for a number of different reasons. And I would say too, it is going to be interesting to see how that evolves, because I think the valuations in venture haven't necessarily come down as much as they should. And a lot of these companies that are still unprofitable are going to still face a lot of liquidity issues, which not that you don't have them in growth or buyout, but they're a little bit different. And the lack of liquidity is I think going to basically, at this point, cause some managers to be on fire or have to really go through their portfolio and figure out which ones are going to save and which ones are not, and frankly also figure out which of the companies that are good am I going to share the next pro rata in the round Or am I gonna basically sell that position because I need to get DPI back to my LPs in order for me to raise my next fund? So it's a very interesting part or dynamic now in the secondary market. The last time I saw a lot of secondary funds being sold was after the .com boom. And there was a lot of stuff on sale. Just because it was on sale, it doesn't mean you should have bought it. So a lot of people lost a lot of money in the secondary market. And that was about 20 years ago. And so it's interesting to see that now there's a part of the secondary market that's developing because we've had so much money go into venture in the last 10 plus years, that's an interesting dynamic that's happened. But I think there is a market there, but there are very few, I think, asset managers positioned to really take advantage of that.
Okay, so
Maureen, to add to that, so it's 25 years ago, because I was running a venture fund through the .com boom bust. And here's the dichotomy is that raising a venture fund was impossible. But if you could find a manager, there were a few that had raised the fund and not spent it, they actually were in an amazing place to be venture investors at that time. And if you weren't, then you could pass. So when it comes to manager selection, it's a pretty straightforward process. What I think you alluded to, though, in the secondary market is you don't necessarily have the transparency to the general partner that you might if you were investing either directly or there's a lot of what are called extension funds. As you said, people selecting out their portfolios, but you still have to look at the health of the firm back then. And I said, and I alluded to hedge funds, 2009, similar problem, great opportunity. Once again, do your work on the manager. If you don't have transparency to the manager, that's something you should probably walk away from, no matter how good the investment looks itself, because the asset may actually be good. The company may be great. And I agree with you, by the way, it's a slow motion direction, and it's made worse by venture lending, having extended companies so they don't have to do down rounds. But the reason I brought up 25 years ago is there weren't just down rounds, there were rights offerings, there were rescue finance, there were bankruptcies. It was way worse than the situation today. So it was more obvious. Where today is that secondary market or even an extension fund is less obvious. So if you can't get the transparency to the general partner or comfort with that, no matter how good the investment looks, I would find a different way of approaching.
I just want to jump in here. Hey, Andy, I think our event last week, we found out from one of the presenters that continuation funds are now more than half of all secondaries.
They are, it's true. And I would also say, just on that note, you can fiddle with your valuation numbers because a lot of times when you're doing continuation funds, depending on how you structure the pricing, you can actually structure it as an earnout. And so if you structure it as an earnout, sometimes you can avoid the revaluation of the assets to some extent, because if you have an earnout, there is the price that you pay, but then you can actually do a DCF of the earnout, the potential earnout. And so I've seen managers kind of avoid, say you only had your last round in 2021 at a really high valuation, and you do a continuation fund before you have to do the revaluation, you do kind of a structure kind of to mitigate the price gap, right? And you do an earnout, and it's a way to kind of smooth out, I would say, the valuation from, say, 2021 when it was overvalued relative to today. And so there are a number of things that I think are driving the continuation vehicles. And one of them, I think, is, if you're in the mix of trying to do another fundraise and you have older funds, you certainly don't want to have to write anything down while you're actually raising for another fund too. So there's a lot of dynamics that are going on now. And the secondary market does offer you some pretty interesting creative tools. But again, you have to be aware. I certainly, if you're looking to invest in a secondary manager, to really ask some specific questions. All right.
So
I'm sorry, go ahead.
oh, go ahead.
Yeah, my inbox is filled with extension funds. And my first thought is when somebody's fund was 15 companies and they're doing extension fund for 5, and that's where I was talking about them being in trouble. What are they telling their original investors about what they're doing about that portfolio of 15 companies and don't assume, by the way, that the 5 companies that I got pitched are the best companies of the 15. First of all, venture capitalists in early stage have a terrible track record of even picking out their own portfolios. They may simply be the ones that were easiest to save. They may be the ones where they had the finance. They may be the ones that they had the best leverage most. So you have to do some work. But I'll give you a second way of doing secondaries. There's a lot less funds doing it, but you could go into a clean fund that is buying secondary shares from companies as opposed to buying secondary LP interests from existing GPs, such as an extension fund. There aren't as many, but if the strategy is something that you can get confidence in, it is a more direct approach because they have transparency directly into the companies that they're buying shares from if they're smart about it. If they're buying them,
And you're talking about like executive ownership of stocks or just anybody? I mean,
two kinds, Marty. So what we've done is we looked at what I call orphan shares, which are the ones you're talking about. It's the CFO and the CEO of the company never went public and they borrowed against it, whatever, and they want to sell some of their shares. That's a good situation because you're dealing directly with people that are the entrepreneurs and founders in the company, the ones running it. The other side are the ones where there were hedge funds that got too illiquid and they shouldn't have been in venture to begin with, that are spinning those out, and you can see them in the newspapers. Those aren't as good because you don't have that connection, that transparency into the company that you would be investing in.
Yeah, I mean, one thing, Andrew, I used to be a PM of a private shares fund that was buying stakes in late stage private growth companies. The biggest hurdle I came across was the companies actually blocking the transfer or it getting ropered away. I would say 60% of the deal flow got scuttled. And so it's not, I would say, evolved as much as the LP market, where now, like 20 years ago, GPs weren't as excited about doing secondaries. Now it's kind of like regular course of business. With companies, I think it's still sticky, and they tend to be more protective about their cap table. Also, the CFOs don't necessarily want a lot of trades because it impacts the 409A valuation. If there's enough secondary trades, that comes higher. But I do think the two areas that you mentioned are good, especially if you're able to get the executive insight, because one of the things that I also struggled with too was how do you really get good, accurate information? And so a lot of that was done through, basically scouring the web for kind of any public information out there, talking to co-investors, but it was difficult. But it is also, I think, a market that people have been trying to solve for. You've seen a lot of these startup companies. There's several here in the city. There's also in Canada where they're trying to provide more information on these private companies and also come up with, I would call it, a better mousetrap in order for basically holders of this private stock and then buyers to be able to transact.
It's like private exchanges.
Yeah, there's a whole bunch now. When I first started, there was just like one or two, and the one I worked for, it's merged into Forge. But now there's Hive, there's a whole bunch. There's ones that just specifically look at options. And so the whole thing is that we have so much because of the lack of liquidity. We haven't really talked about that in the manager selection area yet, that people are just trying to find different ways to get liquidity. The other thing too is, and I think this will happen more to Marty, is that the more you have accredited investors, high net worth and ultra high net worth, come into this market, and that's kind of the fastest growing part of the LP space. These individuals have different factors that are forcing them to get liquidity early, say versus institutions, and they don't really have a great way of actually seeking that liquidity right now. And so I think that you will see more of these, I'll call them fintech related platforms to try to give people liquidity, because it'll just be a natural, I think, outcome of that, especially as you get more.
Maureen, speaking of liquidity, part of this is a bigger picture, as I said, cycles. We went through a period where both in the family office and institutional world, and I used to deal with pension funds, so they can call me now because I have nothing to sell them and I have just free advice. So they're up to their ears in the liquidity, and it's a combination of having committed to private equity, long-term, real estate, long-term, direct lending, long-term, and venture capital, long-term. So it isn't even one strategy, one industry, one cycle. You have this 10 years that went from everybody wanted liquidity in 2011. You couldn't do anything that was illiquid, to the pendulum swinging the other way. So since this is a family office conference, not an institutional conference, what you can do is try to capture illiquidity premium. That is a form of profit. Now, in the venture capital world, as I said before, it's slow motion. We don't have rights offerings yet. I can get into what that is. You don't know. We don't have rescue finance. We don't have bankruptcies. We will. It's coming. Now, is it going to be 2008? No. Is it going to be 2001? Probably not. But there will be opportunity sets, and there are people, as Maureen said, who are experienced, have been around. Those are the people you want to seek out to take advantage of it. Not somebody who just thought this up as, this is a good idea, I'm going to do this, and I've never done it before. So there are people that have been through cycles, and there's no rush. So this venture capital, I'm going to get off that in 1 second, is a slow motion movement, and taking out the opportunity both in the companies that will do well, because the hockey stick projection made the valuation too high, doesn't mean the company isn't going to survive. Just means the valuation's wrong, the price is wrong. So going back, the flip side is, let's talk about hedge funds for a second. I told you, I left the business in 17, there was no opportunity. Well, what happened is, when you look at a track record for a venture fund that says, oh, we had these exits, we had all this great success. Well, that was in a 10 years where IPOs were great and everything was great. The hedge funds are the opposite. There was nothing to do. And now in the last couple of years, I'm actually seeing hedge fund strategies that didn't make money for a decade suddenly doing well, because they survived that dry spell. They were around, and they do have the experience to take advantage of the volatility that Maureen talked about. The volatility in rates, the volatility in uncertainty, the volatility in some of these asset classes there. Direct lending is already drying up, by the way. And that's like the hottest thing. I did my first one in 2006. We did our first fund in 2012, but it's like the newest, greatest thing. And ours
I have 2 questions.
Yeah, go ahead.
So my 2 questions are, you talk about cycles, right? And, old strategies being good, but does that mean that you have to invest in somebody who was, vintage 2008 or 2007? Because, there hasn't been many cycles since 2010, right? We had really a recession, so to speak, outside of the COVID recession, right? I mean, so that's my first question. And secondly, everything has changed from cycles in terms of technology.
Yeah.
Like I have people coming to me who are 60, 70 years old, and they're like, hey, my strategy did great in 2007. It's time for, let's say, value investing, right? I'm like, well, sure, but hasn't a lot of the arbitrage that you had in your strategy been taken out by the quants or by whoever, right? So I mean, I worry about the run room for these strategies. So your thoughts?
Yeah, so Marty, there's 3 things. So one is, I didn't say you just go invest in every old manager that survived. I said that it is fertile ground to explore opportunities. In fact, the opposite has happened to survive. We were talking about big funds before. John Paulson gave them money back, but funds like Millennium or Balyasny, where I was also an investor, they were not multi-strategy funds. They were multi-portfolio manager funds. They both were 100% long short equity. They did nothing else. And now they're God's gift to just being able to invest in everything on the planet, for better or worse. And so not everything, is the answer. I am simply saying is, in both cases, whether it's venture or hedge funds, because the cycle has changed, there are new places to go look. And new things to explore, and to go back to Maureen's comment, try to find people with experience that didn't just start this last week. Now, technology has done 2 things to answer that question. On one side, a third of our portfolio was quant even then. You have quants, but you have the opposite. You have the dumbest investors in the world. What are they? ETFs. It's a formulaic portfolio that was prescribed on day one before it even launched. It has no intelligence whatsoever. It doesn't adapt to cycles. It does absolutely nothing. And I'm excluding things like, I know in the last panel, I'm talking about gold GLD, which is specific to an asset. I'm talking about a more broad-based ETF, including the S&P 500, by the way.
So you
So
guys,
Maureen, do you have any thoughts on the cycle and old strategies, new strategies, et cetera?
I do think technology has really changed things, and going back like 20 and even like 10 years, I mean, things have changed
It's amazing,
dramatically.
yeah.
And the skills and the environment, I'm thinking back, because I've done a lot of investing, not only in funds themselves as an allocator, but also direct and co-invest in secondaries. And I also think about like where the rest of the world was too over the last 20 years. It's changed. It's probably not going to go back again. I mean, thinking about how big China was. The one area where I think experience kind of comes in, and it's more, I think, something you gain over time, and I think about cycles this way, is like your ability to really be very operational and hands-on for companies in terms of just, there was a phrase in the last 10 years where everything was growth, grow at all costs. And now a lot of it has been like, okay, let's get to profitability, thinking of venture growth companies. Looking back, debt was so cheap, what private equity manager really had to think about like restructuring or refinancing their portfolio, right? But those skills, coming back to like, in the 2000s and then the 1990s, your ability to restructure or put together a bank deal or structured bonds, those were actually real skills. And I'm seeing now with higher interest rates and where we are, those skills coming back more into cycle, right? And I think that's because we've come out of that phase from like 2000, 2010, where we just kind of kicked the can down the alley for so long because of the low interest rates. So I guess for me, that's my kind of perception. I think things do move in cycles, but I also think that technology and certain other things have changed so much that you can't just use the same template again.
Yeah, I think you have to look at certain skill sets like a lot closer, which is ability to manage people and to manage younger employees' expectations. Like if you're a hedge fund manager and you've got young guys, they work totally differently than hedge fund people did 15 years ago, 10 years ago, right? I mean, so it's a real tough analysis to do.
That's a good point that you bring up.
Well, Marty, one of the things is from a family office perspective, what technology has done, it's commoditized a lot of strategies. And I think you alluded to that before. So from your portfolio perspective as a family office, the stuff down the middle that's commoditized and that you still need, you need beta to the stock market or beta to real estate, whatever. The stuff that you're doing that way, you should pay low fees and buy the commoditized product because technology has made those things available to virtually anyone. It's the parts of your portfolio that are the diversifiers, whether it's growth on one side in venture capital. And I agree with Maureen, the grow big fast model is done, but that doesn't mean that there aren't growth companies, or the income side where everybody threw their money into direct lending to replace banks is the dumbest idea I ever heard. But there are people around that have been doing trade finance, that have been doing reinsurance, that have been doing all kinds of strategies. They have a lot of experience that have benefited from higher rates. When rates were zero, they had a problem. But when rates came up, their business came back. So the stuff down the middle, you're right, technology has commoditized it. Pay low fees. That's maybe a core of someone's portfolio. I think what we're talking about in manager selection is not that stuff in the middle. It's the stuff where you're diversifying, whether it's on the growth side or the income side, whether it's this taking advantage of the cycle and the opportunity set, whether it's cutting your risk because of cycles, whether it's generating liquidity maybe that you need, or if you have liquidity, capturing liquidity premiums as part of your investment portfolio.
Any other qualities that you guys look for outside of having been there? I'm gonna give an example, like smartest guy in the roomism. There was a guy who was a great private equity manager for years, but he never was able to raise assets. He probably had like $60-70 million under management at one point. A great turnaround guy. He would turn over entire executive teams, et cetera. But one of the problems was that, maybe he had a special pride in having, all of his firms perform. He went down the rabbit hole of one of them and he never came back out. And then his firm had lots of problems. So, I mean, I think maybe agility, maybe you guys could talk towards that as well. And
Yeah, I think there's, so if you're looking at a manager, for me, especially if like it's a first-time manager, it's really hard. And I think most first-time managers, either they're spinning out of already an established fund and they can take some of their track record, or a family office.
and capital.
Yeah, and capital, or it's brutally hard to do it. And you're mostly going on the family office circuit, and it takes, it's hard to do.
Unless you get a bandwagon going, you're gonna be stuck there.
Yes, and one of the things I think too, sometimes let's take the smartest person in the room, I think you need a team, right?
Yes.
Because you can't have, you have to have a leader, but you need to have leaders. And people need to know, I think, especially when when it's starting out as a fund and you're growing your franchise, people need to play multiple roles. But I think you just can't I think it's difficult to have just one person. I think that always makes me a little bit concerned, because at the end of the day, you want to see how the team dynamic is, how decisions are made, how resources are allocated. And frankly, if you can envision these people being together for the next 15, 20 years, because that's pretty much what it takes. I think if you're looking at a private equity fund for a 10-year fund, that usually goes into longer. So that's kind of what I tend to look for, is what is the team? And then as you're fundraising or as you're growing, how are you going to build the rest of your team? And how are you going to incentivize those folks to stay?
So to add to Maureen's point, I think she's right on, and I'll add one more dimension to the question, which is that the guy that was really good at turnarounds, there were no turnarounds for 10 years. So now, yes, he's got an opportunity set. Isn't even more than just saying team, does he have the resources to affect the strategy? It doesn't have to be a team of 40 people. It simply does. Given the strategy that they want to employ, given the opportunity set, does everything match? And does the experience have the resources with it to be applied? One of the reasons our model is to stop running funds, we only do co-investments. We only co-invest with managers because we don't build a team for everything that we want to invest in. We rent one, if you want to look at it that way. So it's the same as Maureen's point, but it doesn't need to grow to be something huge. But on the flip side, one smart guy in a room with no resources, you're going nowhere.
Yeah, I think he had a team. I think the issue is that you probably want somebody who, there's a kind of a fine line between somebody who wants to grow, to raise capital so he can get to that optimal point, right? So.
And the one question I might have, Andrew, is because I helped launch a global co-investment fund, and one of the key questions that we tried to answer and wanted to kind of be assured of was, how do you make sure that you avoid adverse selection? For instance, when you're going out there and you're looking at these co-investments that you might be shown by these other managers, if you're not in the fund, do you ever worry sometimes that you're being shown maybe not the most attractive co-investments, but maybe something?
So I think you're right. And the way we've dealt with the problem is that, so we have like a group of families, semi-captive capital, if you want to call it that. We don't go out and raise money. But everything is set up as an SPV. So the fund sees us as one investor, not a group of people. And to your point is, we're always going to invest some of it in the fund. We're going to hold back the call it half as for the co-investment part, because we can do, let's say the fund is limited to 10% of venture fund, 10% in a deal. We're not. Let's say the fund only does, I'll make it up, Series A. Well, when we follow this company along and they're on their next fund to do Series A, we could still be doing Series B. And we could still, instead of adverse selection, we can also cherry pick the type of risks and the type of funds that are more suitable to our investor base, but may not be what's suitable to the whole LP base of that fund. So you're absolutely right, and we've dealt with that problem of adverse selection by being in the fund. By the way, no control, no veto rights. We do not want to be on the investment committee, and let them do the thing. And then we will And we, by the way, we also only invest in things where we can partner, we can some value add to that fund. So obviously, we're not doing it with KKR, so I have nothing. So, but your point is well taken.
So I have a story here, since we're at Wilson Sonsini, we might as well tell a Larry Sonsini story. So somewhere in the early 2000s, I asked, Larry was on a panel and I was in the audience, and I said, I've lived in Los Altos Hills for several decades. I says, I know lots of people who invested 50,000 or so in angel funds, or maybe pre-series A, whatever they called them at that time. But I don't know anybody who came out with $20 million out of that, because they usually got pay to play or diluted out or whatever.
Crammed down, yeah.
And I says, when I was growing up, there was the numbers game, 600 to 1, and you got paid off all the time. And so, but I don't know anybody who got a 601 payoff on a private basis. I says, what advice would you give? And he said, we're a venture capital firm, but since this meeting is not being recorded, as opposed to this one, he said, I would play the numbers game, because at 600 to 1, you will get paid off. But as an early stage investor, the adverse selection, he didn't use that word, some other investor, that you won't get paid off. So I think it is, it's by the time something comes to you as an individual, unless you're really well known, it seems like, they've shopped it around a lot. And so maybe you have to be careful on an individual basis. But what do you think about, before we wind up, what do you think about individual investments and where people are looking in, and as opposed to their fund, where they're going to put it on their sheet? They need some liquidity, obviously, in bad times.
Are you talking about like direct investments?
No, just individuals, just normal individuals.
So in the interest of time, let me do a super short answer. When you go to, we're on a manager selection panel, you want to look, you talked about pay to play and all of that. You want to look to invest with people that are aligned. That's why we do co-investments. That's why I let my series 24 and 7 go, 17, when I walked away from a big bank, because it was only for compliance. I've never made a nickel raising money or commission dollars. So whatever it is, whoever you're investing with, you want to look for that alignment. You want to look for everybody wins when something good happens, and they don't win when something bad happens. That's simple.
I would agree. That's the number one thing when people ask me about private equity or anything private assets. I'm like, alignment is key. If you win, they win. I think that trumps everything. I've looked at many different set of documentations if I'm doing things in different, countries, and I always think to myself, I want to avoid ever going to court or even having that kind of discussion. But if I get the alignment right, then I think that we're on a good path forward. The one thing I would say about secondaries, though, is that that's the one area where you really can't change anything. So really, the value add that you bring is the price. Now, if you have a restructuring situation or an extension fund, then maybe you're able to change the alignment and improve it. But it also kind of, I think, depends upon how you're entering into that asset. A lot of times with the co-investment, it's kind of a little bit of a take it or leave it. You don't have as many rights versus if you're doing it directly. But alignment in general, though, is the key to making sure
that goes back to manager selection in that, and somebody asked the question, was do we negotiate rights? Well, I will tell you what I tell every manager. I don't want any right that you wouldn't give every LP. Because if you're giving me something special, what are you giving somebody else? All we ever ask for in rights is all the information that the investment committee would have. It's all under NDA. I want all the information the investment committee would have to make a decision. And if there are funds where co-investment is rarely done, which is, believe it or not, common, then we don't have a problem. If there's a fund where everybody's in for co-investment because there's some game going on, it's probably not right for us. So that, again, is manager selection.
I have like a last question, which is, do you guys use AI at all to help you look at managers?
Yes.
Like there was a guy in Florida 15 years ago, he's like a PhD, and he was a professor somewhere, and he used to say, I do a lot of my due diligence just to see where there's just continuities between documents from managers. I don't know, that's,
We do. We're
Okay.
using AI. Yeah.
can you talk about that?
Yeah, so it started probably a couple years ago. I would have an analyst go through and it would take about a day to kind of go through and do the review, and I would have certain things that I'd want them to look for and flag. Now we have a group of quants who've over the past year or so have gone through based upon, you know, the business person telling them like, this is what I care about, this is what I want to know. We use AI and within like 20 seconds, it spits out everything. And I can take a look at it and I'm like, that doesn't make sense. But then I can go look because, you know, obviously documents are very different, right?
Each one of them is.
But it looks for the terms and we have a bunch of folks that are just doing machine learning and it's great. And now we're doing it for financials too, for tracking financials.
Yeah,
And
Maureen, I'm sorry, it's made the process tremendously more efficient. It's all about asking the right questions, and as Maureen pointed out, it's about checking the answers. I just recently read a 98-page intelligence report. I was in South America looking at projects, and I only read it because I got an AI summary of it to begin with, to see what was in it that might be interesting enough for me to bother reading 98 pages. So it wasn't a substitute for reading it, but there's a whole lot of documents and contracts and whatever, research reports, you name it, that could be quickly summarized and you get what you need out of it, or you figure out whether you want to do more work on it. It is not a substitute for doing work, because I can get into the whole AI thing. I was an expert programmer, but it has what's called hallucinations. It will put in things that are incorrect. So you have to ask the right questions. You have to check the answers and make sure that it's accurate, but it's a great tool.
You know, one of the, just as a, you know, one of the things I've always had a problem with is that most hedge fund managers or many managers will represent themselves only in the best light and not necessarily in the context that you want to see, whether it's time frame or drawdowns, or, you know, if they had a bad last 2 years, they'll quote the last 10 years on the conversation, right? And I think AI probably helps you get there faster to see what is that.
Yeah. And it can also help you look at the peer group too. So to figure out like where they stack in the peer group or what's different around them versus their peer group, you know, providing that you have the information in the public domain. And I can give examples of that. But I think AI it's like an analysis tool. It's a data tool. It brings up data, but then you also have to like check to make sure that the data is right and that the data can actually be used to inform your decision.
Are there AI tools right now that allow you to look at peer group easily? Or like, do the vendors who sell the data now have AI assistants, or do you have to kind of create that yourself? Or?
It depends. It depends. Like, so where I've found it useful is that we have built a lot of APIs that suck in the data, and we're trying to figure out like how cost effective, how easily is it to do that, and is the data really that useful? One of the issues that you have also with private equity data is that it's self-reported, right? So you always have that factor too. So I mean, I think it's a variety of, I'll just say, mosaicing to come up with your answer, but AI certainly helps make it easier and faster.
So Maureen, to that point of it's all data is self-reported, so you have a negative selection bias that AI cannot get around, because the stuff that goes wrong, nobody reports. And the other thing you have is you're always looking at past data, whether you're AI or an algorithm, and all that data is created by humans making investment decisions, and it's not forward-looking. So you need to use it as a tool, but no, I don't think just looking at peer groups through AI, there's any improvement over algorithms, because even the algorithm has that negative selection bias built into it.
Yeah, that's true.
Fantastic.
Okay, well, thanks, everybody.